Hello. We are Ding, Stephanie, and Patricia. We will present about liability of auditors and quality control. Let's enjoy our video presentation.
Again. Hi, guys. This topic is on liability of auditors and quality control. Let me tell you more detail regarding this topic. Liability of auditors. It consists of two types. First, liability under statutory law, which is under Companies Act 1965. Second, liability under common law, which due to breach of contract, negligence and fraud. These are the liabilities to clients. Liability under statutory law refers to liability under statute, which consists of BFIA 1989, Securities Companies Act 1993 and Companies Act 1965. Companies Act 1965 govern the auditors in Malaysia. Auditors has specific responsibilities, stated in Section 9, Qualification, Section 172, Appointment and Remuneration, Section 174, Power and Duties of Auditors. Legal reporting liabilities. Auditors can do report but not to detect violation of law that came to the auditor's attention during the course of audit. Companies Act 1965 comprises the duty to report company's financial statement and become whistleblower. For example, to report a breach of non-compliance with provision of Companies Act.
Liability under common law. It does not require the auditors to guarantee their work. However, it requires the auditors to perform with due care. It can be divided into two liabilities: liability to clients and liability to third parties. Liability to clients. If an auditor accept appointment, that means he enter into a contract with client which then indirectly impose certain obligation on him. This obligations may clearly stated, expressed term, or unstated, implied term, in the contract. Auditor is liable to clients for breach of contract, negligence and fraud. Breach of contract, for example, the auditor's failure to complete the job as stated in the engagement letter, which the duties, the fee and timeline should be clearly stated in the letter. The auditor is also required to perform the professional service with due care, same degree of skill, knowledge and judgment with the other members of the profession. Liability to the third party. Auditors are liable for negligence. Negligence is some act or omission which occurs because the person concerned has failed to exercise the degree of professional care and skill, appropriate to the circumstances of the case, which is expected of accountants and auditors. Action against the auditors for negligence can be brought by the client and third party. Therefore, the plaintiff must prove the followings: duty of care, breach of duty of care, casual relationship, damage. Duty of care. Auditor owed a duty of due care to the plaintiff. Auditor has responsibility to perform his duty with skill and care required under the circumstances. If the auditor failed to discharge his duty properly, his client has the right to bring legal action against the auditor either for breach of contract or negligence or both. Action by third party against the auditors for tort in negligence. However, this area of liability is complex and court ruling are always inconsistent. The main difficulty faced by the plaintiff is to prove negligence of the auditors. View under AUD common law was that accountant would not be held liable to a third party outside the contractual relationship, which is based on the doctrine of privity of contract. There are 6 main cases included or involved in this duty of care. Ultramares v. Touchet. Al. 1931. Chandler v. Crane, Christmas & Co., 1951. Hedley-Byrne v. Heller & Partners, 1963. Jeb Fasteners Limited v. Marks, Bloom & Co., 1981. Caparo Industries Proprietary Limited v Dickman and others, 1990. Royal Bank of Scotland v Bannerman Johnston Maclay and others, 2002. Ultramares v Touchet. Al., 1931. The Ultramares plaintiff was approached for a loan. They asked the borrower to provide financial statement. The Touchet. Al. auditor was aware that the audit report was being used to obtain loan, but did not know from which bank. The company went bankrupt after obtained the loan from plaintiff. The plaintiff alleged that the auditor has been negligent because failed to detect or report deceptive accounting entries that hide the company's problem. Judgment. The auditor did not owe a duty of care to the plaintiff based on the doctrine of privity of contract. The court quote that if a liability for negligence exists in this case, an accountant may be exposed to a liability in an indeterminate amount for an indeterminate time to an indeterminate class. For example, the liability of the auditors is no limit. Chandler v. Crane, Christmas and Co. 1951. The Chandler plaintiff invested in a company based on audited accounts prepared by the Christmas and Co. auditor, negligently prepared. Company subsequently became insolvent. Mr. Chandler sued the auditor. Auditor did not deny their negligence and they were aware that the account was used by plaintiff to make investment decision. Judgment. It was held by majority of the Court of Appeal in England that in absence of a contractual relationship between the parties, the auditor did not owe a duty of care to the plaintiff. Under UK common law, professional accountant would not be held liable to a party outside the contractual or fiduciary relationship based on doctrine of privity of contract. Hedley-Byrne v. Heller and Partners, 1963. The Heller and Partners Bank was approached by Hedley-Byrne for credit reference of Easy Power Limited. The reference was supplied by the bank without careful check of the records. Hedley-Byrne provided credit to Easy Power Limited. Easy Power Limited went into liquidation before the debt were recovered by Hedley-Byrne. Therefore, Hedley-Byrne sued the bank. The bank denied responsibility as it owed no duty of care in absence of contractual relationship. Judgment. House of Lords held that the bank owed a duty of care to the plaintiff on the ground that the bank is responsible to give information with due care. One senior ought to have known that Hedley will rely on its information to make credit decision. This judgment eroded the precedent rule in the Ultramares and the Chandler case, and the privity standard is no longer strictly used as a defense measure. However, Heller and Partners escaped liability because it had inserted a disclaimer of responsibility in the certificate of credit references. On the strength of the disclaimer, the bank did not have to pay any compensation to the plaintiff. Jeb Fasteners Limited v. Marks, Bloom and Co., 1981. Jeb Fasteners Limited acquired entire shares of BG Fasteners. In doing the audit for BG, the auditor did not verify the NRV, net realizable value. Instead, they accepted the client's figure. The accounting policy is inventory will be valued at lower of cost and NRV. If the inventory carried at cost, the CO. would shown substantial loss, instead of small profit being reported. The Jeb Fasteners Limited plaintiff brought an action against auditor claiming the account negligently audited and they had relied on the account when acquiring the CO. Judgment. The court held in favor of plaintiff on the ground that the auditors knew at the time the accounts were prepared. The company needed outside financial support and ought reasonably to have foreseen that a takeover was a solution to financial problem faced by BG. The auditor owed the Jeb Fasteners a duty of care in the preparation of audited accounts. Caparo Industries Proprietary Limited v. Dickman and others, 1990. In 1984, Caparo purchased 100k Fidelity plc shares in the open market. In 12th of June 1984, KPRO purchased further 50k shares, by relying on the audited account. KPRO finally acquired control of Fidelity plc. The audited accounts of Fidelity showed profit 1.2 meters. But after takeover, KPRO discovered it should be 400k loss. KPRO alleged that the auditor had been negligent in auditing the account. Judgment. House of Lord, reversing the Court of Appeal. The decision gave substantial comfort to the auditing profession as it held that the auditor owed no duty of care to investors making investment decision on the strength of audited accounts. Most significant decision, auditor were found not to owe a duty of care to unidentified potential shareholders or individual shareholders, unless the account were prepared specifically for a third party for a particular purpose and the intention was made clear to the auditor at the time of the audit engagement. Royal Bank of Scotland v Bannerman Johnston MC Clay and others, 2002. This case has an impact on the auditor's report in Malaysia. The Royal Bank of Scotland plaintiff claimed on misleading audited account in disperse loans and investing in equity of a co. that had to go into receivership. The plaintiff suffered loss and sued the auditors. Judgment. The Scottish Court, in reference to the KPRO case, held that when the auditor did not state the disclaimer statement in the auditor report and did not disclaim their responsibility, they could be held owing a duty of care to a third party if they knew, or ought to have known, that the third party would rely on the audited account for lending or investment decision. Breach of duty of care. Two classic statements have often been referred to in defining the auditor's responsibility to perform with due care. First statement, by Lindley L.J. in Re London and General Bank, 1895. Second statement, by Lopez L.J. in Re Kingston Cotton Mill, 1896. First statement, by Lindley L.J. in Re London and General Bank, 1895. An auditor is not bound to do more than exercise reasonable care and skill in making inquiries and investigation. Where suspicion is arose, more care is necessary. In absent of the above, auditor may be said as breach of duty of care. Second statement, by Lopez L.J. in Re Kingston Cotton Mill, 1896. The auditor had relied on a manager's certificate as the basis for ascertaining the amount of inventory stated in the balance sheet. As a result, the inventory is misstated and inflate the profit. However, to respond to the auditor's responsibility relating to detecting fraud, the judge stated that it is auditor's duty to perform with reasonable skill, care, competent, careful and caution of which depend on particular circumstances of each case, but he is not bound to detect the fraud. Casual relationship. Casual relationship is third condition in a tort. Negligence is the proof of connection between the plaintiff loss and the act of negligence. The plaintiff must demonstrate that the loss is the consequence of the breach in the duty of care and at the time the breach was committed, the loss was reasonable foreseeable as a consequence. Galley Limited v. Bright Graham, 1994. The plaintiff claimed that the auditor were liable for its trading losses for a number of years during the audited account materially misstated. Plaintiff alleged that if the financial position was known earlier, the entity may discontinued its business operations, thus avoiding the huge trading losses. Damages. Damages is the fourth element in the tort of negligence, is the proof of the plaintiff suffered actual loss or damage. Type of damages: loss of investment, overpayment for investment, loss due to defalcation by management or employee, and overpayment of dividends. Contributory negligence: the auditor may be able to argue that the client is partly responsible for its own loss. AUD Limited v. Deloitte Haskins and Sales, 1992. The auditors were held negligent because failure to report to the board of directors the significant weakness in internal control which had caused the loss to be perpetuated and concealed.
Quality controls defines as a system related to the concept of professional competence and the meetings of professional standards in providing services, so that audit failure and audit trick are minimized to an acceptable low level. Reasons why should provide quality audit service. 1. To ensure professional standards are acted in accordance. 2. To restore and enhance public confidence. Elements of quality control. 1. Leadership responsibilities within the firm. 2. Ethical requirements. 3. Acceptance and continuance of client relationship and specific engagements. 4. Human resources. 5. Engagement performance and engagement quality control review. 6. Monitoring. In developing quality control in auditing, the firm should address the following elements. Policies and procedures should be established under the elements of leadership responsibilities for quality. Quality control is important in every audit engagement, then as leaders should promoting it to everyone to appreciate that quality. This is because the highest level such executive managers in the office have ultimate responsibility to promote it. Next, under ethical requirement. Provide the firm with reasonable assurance that everyone to act in accordance with professional ethic, independence, perform job with integrity and objectivity in performing duties. Under acceptance and continuance of clients and engagements, the policies and procedures need to be established is having a proper scrutinized of the clients and every engagement with providing a reasonable assurance for a client whose management lacks integrity is reduced. Next, under human resources. In the process of hiring, assigning personnel for engagement, staff development and advancement activities must ensuring the suitable applicants have possessed the appropriate characteristic in terms of technical knowledge and training that provide with reasonable assurance. Under elements of engagement performance, the policies and procedures should be established is the work performed needs to meet applicable professional standards, regulatory and the firm's standards of quality with provide reasonable assurance to the firm. Last elements, monitoring. Establish the policies and procedures for each of quality control that are suitable, relevant and being complied by members with provides reasonable assurance to firm. Quality control in auditing must develop at A. At the firm level, policies for its own practice, and B. At the engagement level, policies for every engagement. C. At the professional level, setting technical and ethical standards. Elements of quality control, at firm level. Under leadership responsibilities for quality. Policies and procedures should be established by the firm to. Leader of the firm should promote internal culture of importance of quality and performing engagement. Leader must communicate to all personnel in the firm the policies and procedures with respect to quality control. To reinforce quality, leader must come up with a policy to recognize and reward the high-quality work. Leader must ensure sufficient resources for the development and support of its quality control policies and procedures. Next, under ethical requirement. Policies and procedures should be established by the firm. Firms must ensure that fundamental principles of professional ethics to complying with specific standards and regulations. For example, issues of independence, the firm should put in place policies and procedures to evaluate threats to independence and take action to address those threats. Get an understanding of clients' engagement and scope of services. Inform the firm, if there is any possible threat to independence. Under acceptance and continuance of clients and engagements. Policies and procedures should be established by the firm to. It is essential to ensure the client's integrity, firm is competent to perform the engagement and able to comply with ethical requirement. Ensure the firm is thoroughly evaluate existing and prospective client. As an example, to identify the attitude and reputation of the key management, owners, and related parties. From this, the firm will be able to evaluate whether they have sufficient resources or may give rise to a conflict of interest or deciding whether to accept or not to accept the appointment. Under human resources. Policies and procedures should be established by the firm to. Policies of human resource to ensure the staff are committed to ethical principle and carry out engagement in compliance with professional standards and also failure to comply which may result in disciplinary action. Cover the policies and procedures that relates to recruitment process, development of competence, performance evaluation and compensation to the staff. Moreover, to ensure the firm has taken reasonable steps to hire and to have right person that can deliver the high-quality work. Under engagement performance, every engagement team must have capability to deliver a good job. The procedures should address the following matters: on-job coaching, supervision and review, consultation, resolving difference of opinion and engagement quality control review. Lastly, under monitoring, the procedures should address the ongoing evaluation and may identify for necessary changes and periodic inspection on the selected engagement. Any weaknesses of the control system need to have appropriate procedures to overcome the weaknesses. The system should also incorporate the procedures on how to handle the complaints. This is to ensure that the system of quality control remains relevant, adequate and the policies have been acted in accordance with in practice. Next, elements of quality control, at engagement level. First elements under engagement level is leadership responsibilities for quality. Designated engagement partner to every engagement to take overall quality of the audit assigned. The partner should become a role model for other team members and should always promote internal culture that stress the importance of audit quality. Second elements is ethical requirement. The policies and procedures should be established by the firm is the engagement partner must be able to evaluate the client's background and financial statement. This is to checking whether there is any threats of independent to the engagement team and to eliminate it. This to ensure the team able to establish professional ethic during the course of the audit work. Any threats come up must always discuss with partner. Under third elements is an acceptance and continuance of clients and engagements. For beginning audit work, preliminary planning activities must include procedures acceptance and continuance of the client. It is more critical to accepting new client than continuing services to the existing as the auditor possesses knowledge about the entity and the environment. Auditor should investigate the background of the new client before accepting the appointment, such as review financial information, third-party information and communicate it with previous auditors. Next, under the fourth elements. Assignment of engagement team. The policies and procedures need to be established by firm is in development procedures, must ensure that the partner select the audit team that has appropriate competencies to perform the audit in compliance with professional standards and applicable regulatory requirement. For every engagement must be carried out by the appropriate number of staff, time to perform and the technical knowledge that each staff must suitable for the job undertaken. This is to complying with all required standard and regulatory and legal requirements and also to enable appropriate audit report to be issued. The fifth elements is engagement performance. Responsibility of the engagement partner is rise up the performance of the team up to the standard. The partner need to access the planning and the risk, need to timely supervise the team, review process and ensure the engagement team well documented their job before the audit report issued. For separate engagement quality control requires to review all audit of financial statement of listed companies. Lastly, elements of monitoring. The policies and procedures need to establish by firm is engagement team must communicate with the firm for any complaints regarding the quality control policies and procedures for better improvements and also failures to comply with professional standards, thus disciplinary action will be taken. This to ensure the quality control procedures cater the current changes and complied by all members. The objectives are to restore the public confidence and minimize the auditor's exposure to legal action.